Welcome to the MarketBeat podcast. I'm your host, Kate Stalter, and in this show, we cut through the noise and give you real market insights from professional investors, traders, asset managers, and analysts. Our guests put the market developments in context and give you actionable information to make you a more successful trader or investor. Let's get started. One long-standing discrepancy among investors in any market cycle, by the way, is how individuals invest differently from institutions. And in a very real sense, individual investors do have much more flexibility than institutions who have to meet quarterly benchmarks and can't easily get in and out of a security quickly due to the amount they buy and sell. It's a totally different calculation than an individual makes, whether you're an investor or a trader. Famously, the late David Swensen of the Yale Endowment Fund advocated for asset allocation with an eye toward the long term. But what's less well known is that he was in favor of rebalancing depending on market conditions. For example, back in 2009, just as the market was beginning to rally after the big financial crisis, Swensen recommended that investors sell treasury securities that had appreciated dramatically to bring that allocation percentage back down, and then redeploy the proceeds into domestic and foreign equities and REITs, all of which were much cheaper and therefore had higher prospective returns. And that thesis certainly did work out. So in today's episode, we discuss institutional approaches and how they can work in your portfolio. My guest today is Kyrill Asatur, who has a background in investment banking and hedge funds, and he identified ways in which retail investors don't have access to the same kinds of strategies, and changing that has become his mission. In this interview, we discuss a lot of strategies that can help you navigate not only this current bear, but also the bull when it does return. And it will. I know, sounds bleak right now, hard to believe, but the market will rally again at some point, and having an allocation strategy will help you capitalize on that. Listen closely, because not only does Kyrill discuss equities and alternative asset classes like commodities, but also how to manage that neglected part of your asset mix. And yes, I am talking about fixed income. Love it or hate it, you need to know where it fits and which fixed income asset classes shouldn't even play a role at all. We also dive into the question of passive or active management and where a more active approach makes sense. Lots of valuable info for you today. Give a listen to my interview with Kyrill Asatur of Centerfin. So Kyrill, you worked at Goldman Sachs for many years. You were working with a client base of institutional investors. And during that process, you identified a gap between what the institutions had access to versus individuals. So tell me about what you observed and then how that led you to want to change things.
Yeah, that's a great question. So I did cut my teeth at Goldman Sachs. I was there for about 8 years right out of undergrad. And I worked in the prime brokerage business, which is largely, working with the hedge fund clientele of Goldman Sachs, which led me to interact with a lot of the investors that invest in hedge funds. So to your point, institutions such as family offices, endowments, foundations, pension funds, and the like. And what struck me after a while was that these institutions had a very different approach than what was available to most individuals. And the approach involved, to your earlier question, asset allocation that included alternative assets and alternative strategies. So not just your kind of cookie cutter mix of stocks and bonds, but things that were portfolio diversifiers, for lack of a better term, that led to a higher quality overall return. And so after many years of exposure to this, both at Goldman and then on the buy side for the last decade or so, I decided to do something about it. And so the idea for Centerfin was to replicate that approach as closely as possible, that very institutional approach. We sometimes refer to it as an endowment-style approach, but offer it, make it accessible to individuals broadly.
Well, let me ask you this, Kyrill, because I actually owned a registered investment advisory firm for many years. And I bring that up on pretty much every episode here because it is relevant to my approach to the markets. And one thing that I have seen during my career as an advisor, and I no longer am an advisor, but the idea of asset allocation very much caught on among the CFP crowd, for example, just using ETFs or some kind of inexpensive mutual fund like those from Dimensional Fund Advisors, which I used. So has that kind of caught on in a broader sense, or are you looking at something even more distinctive than that?
Yes, it's a good point. So I think the idea of asset allocation has caught on, but I think it is still early. I think, if you still talk to most people that have money invested in the market, whether it be in retirement accounts and 401ks and whatnot, the options are available to them are still pretty cookie cutter kind of 60-40 portfolios. I think that in addition to asset allocation, I think it's the flexibility to go outside of the standard asset classes. And very importantly, the access to certain strategies that are not widely available. So we believe very strongly that active management makes sense in certain parts of the market. And we put kind of alternative investing as an active management style, broadly speaking. And so we were actually my whole team was on the phone with an emerging markets investment manager, because that is one area where we feel like those markets are inefficient. And so a good quality active manager in emerging markets makes all the sense in the world for us. And so we believe that, in a balanced approach, you have some part of your portfolio that's, passively kind of gets exposure to risk assets, but some parts of the portfolio where you want to use active management. And it could be kind of long only, as is described in the kind of mutual fund world, but it could be also alternative, which in our view, we look at as absolute return. And so kind of one of the other areas of focus and something that's kind of near and dear to my heart is kind of the world of distressed credit. That's something where we are working on a more customized approach for an allocation in that space that's going to be very unique to us, that's not widely available. So the idea kind of is to start with asset allocation, but then in certain parts of that process where we use external investment management firms, where we believe we can actually get a higher quality long-term return that will also lead to a higher quality portfolio return over long periods of time.
I feel like I'm hearing more and more people these days, given the current market conditions in particular, but I feel like I'm hearing more and more people talking about some kind of mix of passive and active management. Is that kind of where you're coming from here?
Yeah, we're exactly coming from that place. So, one of our core values at Centerfin is balance. And we think that that's something that's just lacking, not just in the investment world, in the world in general. So when we kind of look at the approach of, how should most individuals manage their money for the long term, we do think the most appropriate approach is, some sort of beta to the market, right? And that could be done very cheaply, passively. And then, again, like areas where we think there's inefficiencies, where active management makes sense. And the thing we have going for us is our CIO, CFO, myself, we've all spent decades in the hedge fund industry. And so we're very much informed by that experience and those relationships. And I think that's something, when we talk to people, it's really hard to kind of replicate that experience and those relationships. And so not only will we lean on that in order to create, very unique access for our clients, but we also lean in on that experience and those relationships to inform our views on the actual asset allocation. So for instance, we think we're today in a very macro-oriented world. And this is actually a change. This is kind of a change since COVID started in early 2020, where macro kind of leading up to COVID, macro as an investment strategy, let's say, was not.
Can you explain that for the listeners just so they know, they can follow? Yeah, thanks.
Absolutely. Sorry. To take a step back, what macro is a particular alternative investment strategy that's basically looking at the macroeconomic picture in order to make investment decisions. And largely managers that use this strategy, and these are largely hedge fund managers, this is actually how the hedge fund business started back in the day. It was very macro oriented. They largely make bets in asset classes. So, government securities, foreign exchange, kind of big markets. So where they can, move around and change their exposures fairly quickly. And so they're not determining, as opposed to kind of a fundamental bottoms up strategy, which is maybe, in the kind of traditional long, equity value strategy where you're looking at all value stocks in the market and you're kind of picking your top 10, 20, 30 names. It's kind of the opposite end of that. They're kind of looking at the geopolitical macroeconomic picture. They're trying to figure out what's happening next and trying to position their portfolios in that way. And so for us, we have a lot of connectivity with, again, kind of the hedge fund community. We're talking to these macro managers all the time. We noticed a shift in, during COVID, because all of a sudden you had the Federal Reserve, the federal government globally started to kind of step in and provide liquidity into the markets in order to be able to, kind of help with the situation that we were dealing with, this global pandemic that shut down the global economy. And so all of a sudden, the actions of the Fed, the actions of the federal governments, not just in the US, but globally, became very, very relevant to what was going to happen in markets. And so we lean very heavily on our kind of relationships in that space to help inform our views, because it is what we think primarily is driving where markets are going. And as we sit here today, I'm trying not to look at my screen because we're hitting new lows on June 13th year to date. And, it's very liquidity driven at this point. The fundamentals don't matter so much when you get into these inflection points in the market.
Yeah, it's like it all just goes out the window. And what I get concerned about with individual investors with a macro thesis is that perhaps they're not operating really on a macro basis, but on hunches and emotions and fears. And I'll give you a great example of what I ran into repeatedly as an advisor is the presidents of different parties. And I'm not going to get political here. I'm just going to say that when President Obama was in office, I had people that wanted to bail out of the market because they were afraid of what he was going to do, and that would have been to their detriment. When Donald Trump was in office, same thing. Other people wanted to bail out, and that would have been to their financial detriment. So how do individual investors sort out this idea between, well, I'm operating on a macro thesis, making it sound sophisticated, versus I'm just operating on pure emotion here?
That's a great point. So, taking a step back, I think one of the other reasons we started Centerfin was because we felt like a lot of the traditional Wall Street institutions that manage money for individuals, the incentives are not always aligned, right? So there's oftentimes, they're incentivized to sell products and whatnot. And we didn't want to do that, right? We really wanted to start with, let us bring something that we think is better to individuals, including our friends and family, because, for many, many years, when friends and family would come to me asking me for advice what to do with their money, I didn't really have a good solution for them. And so that was kind of, one of the things that I wanted to do was be able to help them when they came to me. And so as part of that, we want to empower and kind of educate these individuals. And we truly mean that. We're not trying to, again, it's not for the purpose of selling them something. We really want people to get comfortable with what is going on in the world. And to your point, oftentimes individuals that are not following the market day by day, tick by tick, they will get a hunch, like you said, and they will want to make a decision based on that hunch. And hopefully what we can do is give them enough information and support that information with data, obviously, to help them make better decisions. And to your point, and this is what we manage money on a 10, 20, 30 year time horizon, because our client base is relatively kind of our age in their 30s and 40s. And, we tell clients all the time, you still want to have a lot of equities exposure, because equities are an asset class that long-term will compound, at a higher rate of return than a lot of other asset classes. But we can kind of help tweak that along the way and be tactical. And I actually heard an interview that you had where you talked about, being tactical. We think it's very, very important in this market, because you don't want to make, macro offensive bets, but you want to be defensive in this kind of environment.
Absolutely. That's a great way to put that into perspective. So let's get a little more specific then. And I know that you cannot give individual advice, neither can I. We're not doing that. But just from a big picture point of view, how should investors be thinking of their allocation right now, maybe in terms of asset classes, which we started to talk about a little bit a few minutes ago?
Yeah, that's a great question. So we document everything that we do so that we can be held to our account. And so late last year, we were getting fairly concerned that this inflationary situation that we find ourselves in 2022 was going to be more permanent than transitory, which is what the kind of the very prevalent narrative was from the Federal Reserve and from the federal government. And so we sat down to think about if there's one scenario where inflation actually is not transitory and it sticks around, what is the easiest way to get hurt? And the easiest way to get hurt in an inflationary environment, if you go back and you study other periods, which we haven't seen in, as you know, in many, many decades, is being long fixed income assets, right? And so And fixed income is a portion of our client portfolios, just broadly speaking, because it does create a nice balance to, some of the other type of risks that we take. And so we decided on a kind of a wholesale basis to largely get rid of any traditional fixed income exposure. And the reason being is because if you think about, and we wrote about this, but if you think about what fixed income is, right? Fixed income is a debt instrument that pays you a fixed coupon, and that coupon is generally based off of the risk-free rate, which is the U.S. Treasury obligation. And so where the U.S. Treasuries have been at such low rates for such a long period of time, traditional fixed income obligations of corporate issuers were trading at, very low yields. And so if you take a look at the real yield, meaning the yield that you get on that fixed income security minus the inflation rate, they were trading at negative real yields. So you're losing money by holding those securities. And so we said, well, that's not going to last, right? That may last for some period of time, but if it persists, people are going to start to exit fixed income securities. And so we kind of decided to get ahead of that. The other thing that we did very consciously, and we've done more of this in 2022 so far, is we believe very strongly that, having commodity exposure in client portfolios is very important. If you live through the period of kind of 2000, 2010, if you lived through the 1970s, if you did not have commodity exposure, those are very hard periods of time. A lot of people don't realize, but, 2000 to 2010, if you were just kind of long stocks or long a 60-40 portfolio, you ended up making no money for a whole decade. And so we believe that having commodities as part of the client portfolios is very important. So we came into the year with commodity exposure. We've increased it over the course of 2022. We continue to believe it's a very important part of, to have exposure in client portfolios right now. And look, if things change, we'll change also. But for right now, that's how we view things.
Not sure what stocks to buy and which to sell? Well, no worries. MarketBeat has you covered. Get the latest buy and sell ratings from Wall Street's top performing, most accurate, and most respected research analysts. That's just one part of what you will receive as a MarketBeat All Access subscriber. You'll also get MarketBeat's new trending stock lists, which monitor social media chatter in real time to help you identify the next GameStop or AMC before you hear about it on the news. MarketBeat All Access also features real-time news, market events, and performance data for your stocks with the MarketBeat portfolio monitoring tool. And you can take a completely risk-free trial for just $1 if you head over to the link we will put in the show notes. You'll get best-in-class stock research tools, performance ratings for Wall Street analysts, real-time news feed, executive support team access, all of this ad-free for just $1 for the first month. Sign up today. The link is in the show notes. Yeah, I like that you framed it as right now, because I recall after the 2008 market meltdown and commodities had done better during that period of time, and all of a sudden everybody wanted to jump into commodities to offset any weakness in equities. And that did not work out well for many years, but now it's working again, isn't it?
Yeah, I think you need to be in this environment. I think you really need to be cognizant of, not to go back to the macros, but you need to be cognizant of what's going on and make adjustments along the way. Not too often, but where appropriate. And I think that, the problem with a lot of the approaches that we see out there today is that the industry has moved into this place where, I'm sure you're familiar with this term of robo-advisors, right? And we actually we don't think that's a good idea in this environment. It worked for, the last decade or so because markets were conducive to it. But this automatic kind of rebalancing and kind of just using a standard model that's based on modern portfolio theory, which is ironically was, designed in the 50s, is just not going to work in this environment in our view.
Let's talk a little bit about fixed income again, because you had mentioned a few minutes ago the idea of distressed credit. And I understand that differs dramatically from something like an investment grade long-term corporate bond. But talk a little bit about how you see that and for your investors, and why distressed credit may be an interesting asset class at this time.
Yeah, so that's a great question. So at Goldman, I covered a lot of credit hedge funds. I don't know why I was kind of given this, over-indexed allocation of coverage for credit funds, but I tended to, I think, like those funds a little bit better. Particularly in distressed credit, what I really like about that space is that it is also an inefficient area of the market. There's a lot of markets that are very efficient and where it's very hard to generate, as they refer to it as alpha or returns that are better than a benchmark or an index. But distressed credit is one of those areas, right? Because you have an opaque market. You have uneconomic sellers quite often, particularly in periods like this. Again, as volatility has picked up in 2022, things get pretty interesting. And so that's an area, like I said, we know very well, and where we hope to create very unique exposure for clients to be able to access that market. And it's much less correlated to other asset classes and strategies. And that's something we like about it a lot, because it acts as a natural portfolio return enhancer.
And let's get specific on how investors can access that asset class. Are you talking about high yield bond ETFs or something different?
No, something different. So we can't talk in too many specifics at this stage, but we're working on something where it'll be kind of a proprietary vehicle that's only available for our clients.
Okay. But generally speaking, if one of the listeners is not one of your clients, what type of asset class approach should they take?
There isn't a ton. We've looked at kind of what's off on the shelf out there, and there's, for what I'm talking about, there isn't a ton. There are high yield bond ETFs and high yield mutual funds and the like. We don't really like that approach. We think being, strictly long, high yield fixed income is actually, in this environment, is a pretty risky proposition. Same thing as being long just any fixed income, right? And, high yield offers you a little bit more yield, but it's got some significant downside potential. So off the shelf, frankly, it's hard to get the kind of exposure we're looking for.
And I've always been somewhat, not suspicious, that's not the word I'm looking for, but just a little bit cautious around high yield bond ETFs, simply because they do tend to sort of replicate the same risk levels as equities. And I think a lot of people don't understand that. Let me come back to another asset class you mentioned, which was emerging market. And the same thing. Is that something that listeners perhaps and who are not working with you, should they be looking at emerging market ETFs? Should they be looking at something more tactical to perhaps use in certain market conditions?
Yeah, that's another market. And, like I was saying, we were on with an investment manager right before, and I don't want to mention their name, but we do think that that's a market where you can find quality active management, because it is a market that's less efficient. It's very interesting right now because obviously, a big part of emerging market funds and ETFs is China and India. There's very different stories that are happening in both of those markets right now. If you follow the news, China, for the first time in a very long time, has a very different stance towards the world. And so having an insight into that and being able to use that insight, and this is why we would lean on an external manager, because they're, more boots on the ground, they're much more plugged into what's actually going on the ground there, is very valuable. India is a very good story right now. And we think, potentially, having exposure to India through an emerging markets manager is also very interesting. But again, I think it's very important to kind of do your research, figure out, that it's somebody who has an approach that you think makes sense. And that's kind of, that's one of the things we look for as well.
Yeah, and accessing that asset class in any meaningful way, frankly, is difficult for U.S. investors, just because it's very hard to get out there and pick a single stock of a pharmaceutical manufacturer in Ghana. I'm just making that up, but it's the kind of thing that how could you as a U.S. investor actually get out there and pick stocks? So I agree with you. A fund of some type would be the way to access that particular asset class. Hey, Kyrill, thank you so much for your time today. This has been a really interesting discussion, and you do have somewhat of a contrarian point of view, which I appreciate, and it is always fun to hear about. If the listeners are interested in learning more about Centerfin, how do they find you?
So I am Kyrill, Kyrill, at centerfin.co, and you can obviously look up our website. I'm also on Twitter, where I'm trying to get a little bit more active and engage with people. It's Wall Street Hobbs, Wall ST Hobbs, HOBBES on Twitter.
Great. Hey, thank you so much. Really enjoyed the conversation today, and we'll have you on again some other time.
Thank you so much, Kate.
Thanks again for listening to the MarketBeat podcast. Do not forget to subscribe on Apple Podcasts, Spotify, Stitcher, Google, anywhere else you get your podcasts. And you will also find us on MarketBeat.com. If you enjoy the content here, please give us a 5-star review so others can also find all the great interviews and market insights that we bring to you each week. Also, did you know that MarketBeat has a YouTube channel? We sure do. The podcasts are there, as well as tips for getting the most out of MarketBeat and becoming, as always, a better investor or trader.